Hi, this is Antoine Harris with Platinum Bridge Wealth Strategies. I'm at a meeting in Atlanta. I'm recording this from my hotel room. The Federal Reserve raised interest rates again today by 0.75%. Fed Chair Powell has been very clear that he's focused on getting inflation back down to the 2% level. So that means we have several more rate hike cycles to go in order to bring rates up to a point where he's going to be able to get this inflation, quote unquote, under control. The Fed has an extreme challenge because they're using lagging indicators like the unemployment rate and the rate of inflation to make decisions in the present that aren't seen, they don't take effect for several months in the future. They're using old data to take actions now that don't have an impact for several months into the future, actually up to 18 months. So this is an impossible situation to predict. We're going to continue to have market headwinds and market volatility until we get a perspective from the Fed that they're able to stop raising interest rates. I don't think we're going to start to cut interest rates through 2023, but I anticipate them being able to kind of hit the pause button. And that may be the catalyst that the market needs to be able to see some more sustained growth. So throughout this situation, many clients ask, should we be doing something during this period of market volatility? The answer is we need to stay invested. If we have cash on the sidelines, we need to slow roll that cash into the market. Money that is already invested must stay invested for several reasons. But the main reason is because markets, when they change, when the sentiment changes, markets react very quickly. Here's an example. Over the summer, the sentiment changed sometime around mid-June, and the market had anticipated that the Fed was going to stop raising interest rates or quote unquote pivot sometime during the latter part of this year. The market starts to make a move about 6 months in advance before something actually takes place. So the market mid-June, this is June 16th, this is the S&P 500, one up. This represents a 16% move in 2 months. So when the market sentiment changes, it changes very quickly. So from June 16th through August 16th, we see this 17% move very quickly. Now the Fed came out and kind of put some water on that whole theory that they were going to change and kind of pivot with possibly cutting interest rates, and you saw the market come back down. Once we have the true pivot, once these markets actually change sentiment on a more sustained basis, the move happens very quickly. When we look back historically, this chart shows the growth of $100,000 over a 20-year period. That's roughly 5,000 trading sessions. If you stayed invested, that 100,000 grew to 616,000 plus. This is the S&P 500 again. If you missed just 10 days, that's 10 days out of 5,000 trading days, you reduce the return from 616 to 282,000. If you missed the 25 best days over a 20-year period, you reduce it down to 134,000. So the fact that the markets, when the sentiment changes, it responds very quickly. If you miss those best days, just 10 best days out of 5,000, you could cut your return more than half. We need to stay invested. New money that's coming into the market, we invest it gradually and get it pushing properly over time. Now, the other thing to keep in mind is typically the higher risk assets tend to do better coming out of a market downturn or out of an economic recession. So since 1975, small cap stocks, small company stocks tend to be up over 30% the year after a recession. Mid-cap stocks over 23%, then the growth stocks, then the value stocks, then the overall stock market. So what we try to do is when we filter new money into the market after a downturn or during a recession, we want to make sure that we have adequate exposure to some of those more risky assets, because when the markets recover, they tend to do better coming out of a downturn, out of a recession. Now, the good news is this market downturn has been indiscriminate. So this is year-to-date data. We know that commodities have been up. You saw what happened with oil prices. Cash has been basically flat, but every other asset class around the world has been down. This is as of September 20th. Bonds, which are supposed to be the safe haven, have been down almost 13%. A typical asset allocation of 60% stock, 40% bonds is 15%. High yield bonds are down over 15%. Large company stocks, 18%. Small company stocks, 19%. Energy markets, 21%. Real estate, 21%. And developed market international, down over 22%. This particular situation, there's been no place to hide. But when you have this kind of indiscriminate selling, invariably some very good investment opportunities are thrown out with the bathwater, the proverbial baby with the bathwater, and it presents some really strong investment opportunities over time. So the key is to reposition the portfolio during the downturn so that you could take advantage of the markets as they recover. I do not have a crystal ball. I anticipate we're going to have continued volatility, continued headwinds for the next several months. It's something that we need to sit through. We plan for this, but the good news is this actually presents opportunities longer term for investors. And as you know, you should always have a longer term horizon for any type of stock based investment. You should always have at least a 7-year runway before you ever need to pull any money out of the stock market, because these types of economic cycles, these types of variability in the stock market is typical. It is normal. And we go through a downturn of over 20% roughly every 4 years. This is Antoine Harris with Platinum Bridge Wealth Strategies. If you have any questions, please don't hesitate to reach out and I'll chat with you soon.